It is 11 o'clock. We can get going. So thank you very much for tuning in today. I'm going to be doing news as normal, and then the guest this week is David Bird from Octopus Renewables. Few bits of news first, as you can see there. I'm going to start with Gresham House Energy Storage. This is complicated, and I feel like I talk about it too much, but it's complicated. So the market has about 400 million. The discount has been narrowing a bit, as you can see there, but it's still quite wide. And the new news is that the yield has disappeared. This is from their half-year numbers. So basically, the NAV is edged down a bit. And there are some quite big moves there. Mainly that there's been a big cut to third-party revenue forecasts, which we'll talk about a bit more in a minute. And they've sort of clawed that back through various means, one of which is extending the projected asset lives of the batteries, which feels like an accounting trick, but obviously will be done on real-world evidence. But nevertheless, it doesn't sit entirely well. But we've got an NAV that is marginally down, basically. Now, this thing about the revenue forecast assumptions, it relates to forecasts beyond 2030, and you can see the changes here in that graph at the bottom. And they're saying it's being driven by forecast prices for gas coming down, and the idea that Drax won't close because Drax burns biomass. We know it's not really green, and there are lots of people who want it to close, but they're sort of suggesting that it won't do. Yeah, well, we'll see. But I was surprised by the magnitude of those changes there. Now, in terms of the sort of day-to-day income, the important thing is that the batteries are actually used when the grid is running short of energy. And there was a long period where they weren't being used, and instead the National Electricity System operator was using diesel power instead. So they're just switching on diesel generators, which is also massively polluting and not very efficient. And it was really down to the software systems, and so the software systems have been upgraded. One of the things that Ofgem's now required is that battery operators put in systems that let the NESO know how much power is available. And they're thinking that if they know how much power is available in each battery, they'll be more likely to call on them. And so therefore that improves their usage, which obviously is good news and hopefully will happen. Now, Grid wants to massively ramp up its capacity. So it's already got a very big portfolio, probably one of the biggest in the UK. And they're saying they want to more or less double the size of that. And part of the way they're going to do that is by extending the duration of the batteries in the portfolio from 1 hour to 2 hours, and that means upgrades, which needs investment. And they think they can get there by 2027, 28. If the revenue stayed the same, so say last year it was about £75,000 per megawatt per year, that would generate free cash flow of about 10p a share to support dividends and things. We're coming from a position where in that period where NESO weren't really using batteries, those revenues fell as low as 48,000. But they've done a whole load of deals, basically insured their income so that that's now capped at a floor of £50,000. And they're paying money to do that. So there's quite a big chunk coming off their revenue to get this done. And we've talked about that before on the show. And they're saying, well, there is a possibility that we get up to £90,000 a year in 2028 for 2-hour assets, says third parties. Now, if we go back now to the chart we just looked at, I don't see that on that chart, do you? And so I'm not sure where that's coming from, but nevertheless, that is what they're saying. The helpful thing in terms of getting this done is that the prices for batteries are coming down. So $115,000 per megawatt hour in 2024 and still coming down. And a lot of it is coming from China. The US is slightly hamstringing itself by saying the batteries need to be produced in the US, and that's all more expensive, but they're not that fussed about doing this anyway. But here in the UK, as long as we keep importing these Chinese batteries and the prices are still coming down, then this all makes sense. And because it's saying we can see the upside from this, we want to get on and do this whole 3-year plan that we've got. But it's very tight on cash. So we'll talk about its refinancing debt in a second. But they're basically saying we don't want to pay any money out of the company if we can help it. So they've already cut the management fee. And again, we talked about that before. They're now saying they want us going to pay negligible dividends, just enough to keep their investment trust status. So 0.11p this year, 0.25p next year. And then the dividends will be funded from free cash flow in 2027 onwards. But that money also would be needed for buybacks if they're going to do buybacks. And I think that also implies they're not going to do any share buybacks, at least until 2027. The debt thing, it's all helped by this putting the floor in. So that gave the lenders the confidence to lend them the money, which meant that they got the refinancing done at a reasonable rates. And obviously, SONIA is the overnight interest, short-term one, and that's coming down anyway as the Bank of England cuts rates, so that's all helpful. And they're going to keep the debt within sensible-ish levels, so LTV about 30%. But the new projects that they do put in will be part debt finance, so that'll be in the structures, and they're trying to basically put them into special purpose vehicles so that if one of them falls over, it doesn't bring down the whole thing, which is all sensible. So this is the rollout plan that they've put forward, and everything in the yellow bars there is the additional capacity that they're bringing on that they've got the money to do based on doing this dividend cuts and using the new debt facilities. They can get that through all the way through there to over 2 gigs, which is great. The pink stuff, though, they need to work out how they're going to pay for it. And they've talked about using third-party finance as one way of doing this. So this is a watch and wait and see thing. Obviously, that might come at a cost and that might affect the revenue, but we'll see how we go. Now, the thing that worries me is you've seen that enormous shift in the forecast revenues. One thing that's mentioned in the interim report here is that the government is trying to find ways of incentivizing storage providers to provide AR projects. And it says Grid is looking at this opportunity. We're basically then, it's a whole new ballgame in terms of investment and how they finance that, we don't know. And would they be able to take advantage of this, we don't know. I do worry there are a lot of unknowns in all of this. And I kind of coming to the conclusion that this discount is justified, and especially we're not going to have any buybacks, not going to have any dividends. I don't really see where the share price upside comes from in the short term. When I say short term, I mean the next couple of years. So they're going to have to work hard, I think, to convince investors to stick with them. Mansion London, another one on a big discount, obviously has been doing extremely well. Now, the blip that we had is now looking like a blip in terms of what happened in 2025 and more to the point, what happened in 2022. So there was a big pullback in the NAV in 2022 as people sold off growth stocks. They come back, clawed all that back. We had Liberation Day and the impact of that, massive great fall off again. We've come back from that. So basically this thing is volatile, but it is delivering on terms of generating a higher and higher NAV. But what we've seen is this widening of the discount. And that, I think, is only, again, going to get worse and less people will buy into this story. The numbers are very good. So this is on the back of another good year in 2024. So, so now 30% increase in the NAV is obviously very good. There is no real sensible benchmark for this. NASDAQ is probably a lot more sensible than the old benchmark, which is MSCI UK, which they've got rid of, I think, because MSCI was trying to charge them money to use it. So the firm there hasn't got a benchmark, not officially, but I think we can still say that this thing is doing very well. And the reason, obviously, that people are wary of it is the concentration in the portfolio. So you've got 64%, it's almost 2/3 of the portfolio, and two stocks there, Nvidia and Microsoft. And I get the argument for why people say, because it's one that I've used myself, you've got to think about the concentration risk when you're thinking about whether you want to make an investment in Manchester and London. It's a real thing. But the other thing is, most of us could probably go out and buy those two stocks ourselves. So why do we need to pay somebody else to do it? And I think that is a factor too. And I think the most interesting thing with this is going to become when they decide that Nvidia and Microsoft are not the two best ways to play this, that there are other things to invest in and that deserve a sort of a bigger percentages, and what happens to the portfolio then, how it performs then. I think that's the sort of question mark maybe. But let's not knock it. It has been doing extremely well. So to try and keep the discount down, they have been buying shares, and the manager's also been buying stock too, and has built up a sizable position now, so that the free float is getting down towards the 35% limit, where it would struggle to be classified as an investment company. And if it loses that status, that changes everything around the tax, and that obviously would not be good. And so the board suspended buybacks for now. And they've also said that the insiders, the sort of people that affect the free float, won't make any more purchases. So it comes down to, will shareholders buy it instead? And I think the chair asks a valid question here, which is just like, you've got something like Polycap Tech, and they use that as an example in Manchester and London, that is done phenomenally well, and yet it sits at a discount. Why? Doesn't really make sense. And yes, there's the concentration risk you mentioned, London, you don't have in Polycap Tech, but it's performing extremely well. Why aren't people buying it? And are people just too risk averse? And I think there's a valid question, but I'm not going to try and answer that. Last one here, Target Healthcare REIT. I genuinely don't understand what's going on with that share price at the end there. You'd see that the discount was starting to narrow. You'd see that the share price fall was not justified at all in the first place, because given what happened to the NAV, the discount was coming back, and now it's widening again. And it's about 20% now, that puts on the yield 6%. And they've just done this deal where they've sold 9 care homes for 86 million quid. It's a big chunk of the portfolio. They've done it at a big premium to the carrying value, net asset value. It actually de-risks the portfolio because they've cut exposure to the largest tenant. They've done it at a yield of about 5.24% in terms of the valuations that they've sold them at. It's tick, 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 really, in terms of buying things, turning them around and selling them on again. They really to demonstrate you can do that. They've also put new debt facilities in. It's quite a busy slide, so I'll let you just look back at that another time. But the basic message here is part of the reason why people were wary of it was because it secured some very cheap debt when that was available, and then people knew we were going to have to refinance that. But having done this, it seems to have been done at reasonable rates, so the weighted average cost of debt hasn't gone up by very much. They've got a facility to fund new acquisitions if they want to. And they've got a whole bunch of stuff that they could buy and are looking at buying. So, and this, given they sold this at 5.24, the new stuff comes in at 6, and then they can work to try and improve that beyond there. So the first deal of those is done in November. So what I'm kind of saying is this is doing quite well, really, and it doesn't really make sense to me that the discount is widening. That is enough from me.